Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. I entitled this video The End of the Cubicle Class because of the profound changes about to likely unfold in today's work environment. To make it clear, I don't see cubicle workers becoming extinct, but I do see a significant reduction in this type of worker over the next 10 years. There are obviously still a lot of unknowns, and that is why I added the question mark. I most recently addressed the changing workforce underway last September in an Under the Lens video entitled U.S. Labor Market in Productive Decline. In that video, I focused on three main points. First, the precipitous drop in U.S. and overall developed economies' productivity. Two, the shift to working from home that COVID-19 launched. And three, the generational change within the over 70 million millennials and 70 million Gen Z generation regarding their attitudes towards work. I encourage you to review the video if you haven't seen it because I won't have the space in this session to do that. What I hope to achieve in this session, however, is to focus on additional developments which are now occurring that are going to have parallel impacts that will undoubtedly further alter the workplace landscape. As such, I want to cover the items outlined here. I want to start with what I see as the precipitous point we have now reached, which I believe is going to rapidly accelerate change in the traditional urban center workplace. American worker productivity is presently declining at the fastest rate in 75 years. The U.S. has now had 5 consecutive quarters of year-over-year declines in productivity, according to data from the Federal Bureau of Labor Statistics. That is unprecedented and has never happened before in data going back to 1948. U.S. productivity plunged 2.7% in the first quarter of this year compared to last year. That's a 0.9% year-over-year drop. Concurrently, quarter-over-quarter output grew slightly at barely 0.2%, and hours worked grew quite high at 3%. That means people are working longer hours and barely putting out more products because they just aren't as productive as they used to be. The drop in productivity is now exacerbating compensation pressures and pushing up unit labor costs. The difficulty is that there is no magic productivity wand, and cost-cutting via layoffs and wage growth compression has become viewed to be the easier and faster to execute. Unfortunately, productivity is only solved with a longer-term view that most CEOs don't have the luxury or often funding to adequately and effectively address. And this is not just a U.S. problem, it is global. When you have an environment in which output is outpacing labor growth, that's an environment of stronger productivity. When you have the opposite, when output growth is sluggish but labor growth is strong, you have a weak productivity environment. A rebound in productivity is critical to solving many of the developed economy's current issues, since it would lift supply and thereby reduce inflationary pressures. Over the past 5 or 6 quarters, economic activity has been sluggish, even as the U.S. has seen a resilient labor force and continued job gains. People are working longer hours, so labor utilization has also been higher. Unit labor costs grew 6.3% this quarter, while compensation only grew 3.4%. That combination has created conditions for the perfect storm, with weak productivity for 5 quarters straight for the first time since post-World War II. Over the past 18 months, the churn of labor has been tremendous. The recent BLS and JOLTS reports have found that the number of job openings, hire rates, and quit rates have all reached record highs. It has been very difficult for employers to essentially train their employees, bring them up to par with the productivity levels which would have been deemed normal in the pre-pandemic era. When the pandemic hit, it brought a combination of early retirement, a mass exodus from the workforce, and an avalanche of job switchers, a phenomenon alternately called the Great Resignation and the labor shortage. Taken together, it created a dearth of productivity. Because people were job hopping so regularly, there wasn't really a chance to bring them up to speed or productivity. that a former worker would have had. In other words, the outsized rate of churn has been a key, if underappreciated, factor in sluggish productivity. Productivity is the key out of this mess we've been in, since the current environment is one of constraints: supply chain constraint, labor constraint, and capital constraint. Increased productivity would alleviate each of those concerns as well as cost pressures. One of the reasons sluggish productivity hurts the economy is not just that it limits supply, it leads to inflationary pressures. Think of it like a working employee has a cost. They have to be paid. That wage is offset by their productivity. What matters to an employer is how much they're paying per unit of output. That's unit labor cost. Generally, it's difficult to ascertain how flexible work will impact productivity and, in turn, unit labor costs. But the whole idea of remote work and flexible work is to allow people to be more productive. Granted, that hasn't always worked out according to plan. Workers have been using flexible hours to do things they otherwise wouldn't have had time to do during the workday, like laundry, grocery shopping, or would have had to delegate to someone else, like child care or elderly care. Those are circumstances that Jamie Dimon, the CEO of JP Morgan, has pointed out to argue remote workers are less productive because they're doing chores instead of working. And we went into that in my last video. Hopefully, we're moving towards equilibrium, where all sides are trying to be as efficient as possible to get work done in their desired amount of time. That would mean a gain in productivity. But frankly, I'm quite skeptical about that actually arriving. Wall Street's worries about corporate America's dwindling profit margin appear to be very real based on the earnings call I've been listening to. A few themes are already becoming clear. 1, cost and jobs are in. 2, spending and expansion are out. Fears of the impact of rate hikes and a looming economic slowdown have U.S. corporations rushing to divert to efficiency from growth mode. Buzzwords like personnel costs and spending on hiring in earnings calls plunged 80% from last quarter. The decrease in such mentions is a sign that hiring has come to a halt and reflects the workforce reductions now underway, which I've been highlighting about in our weekly newsletters. It has become more about right-sizing to revenue growth. The cost cuts are out of necessity in an attempt to preserve operating margins. Spending will return when revenue growth reaccelerates. The cuts were incredibly effective, with most companies significantly exceeding earnings expectations, and with the stock prices generally going up, management has to see that investors are rewarding profitability rather than pure growth. So we can expect the belt-tightening to continue for a while. And while tech names have been the most bloated after splurging on hiring during the pandemic, it's certainly not the only sector working to reduce expenses as economic conditions change. Corporate America is great on the front end in terms of staying ahead of the competition with robust hiring, but they're also quick to counter that trend and lean down to support and protect the bottom line of their margins. We're seeing a lot of that play out in the earnings calls we've been experiencing here in recent days. What is becoming clear to me also is we are about to experience the concept of logarithmic decay. Logarithmic decay is like how Ernest Hemingway famously described going bankrupt in The Sun Also Rises. Quote, gradually, then suddenly. End of quote. The idea behind logarithmic decay is that something declines very, very slowly at first, but over a long period of time, the rate of decline becomes faster and faster and faster. If you look at it on a graph, logarithmic decay basically looks like a horizontal line that almost imperceptibly arcs gently downwards, but eventually the arc downward becomes a steeper and steeper until it practically is a vertical line down. There is a lot of academic, social, and physical theory behind this, which I will leave you to explore, but is likely what is ahead. Why? Because corporate CEOs have found themselves in a position that if they don't fix productivity, which they've been nibbling at, their jobs will soon be gone, as corporate boards can't answer shareholder questions adequately concerning falling margins, falling revenues, profits, why did they do buybacks, and the amount of dividends that they've already paid out. Hey, what they've been doing is nibbling at the problem as opposed to a full frontal attack, and I think that's about to change. And for a number of reasons that we'll get into. Corporate boards and CEOs have brought this on themselves. because they have expediently spent their free cash and balance sheet leverage on stock buybacks and increased dividend payouts over the last decade versus capital and employee investment. The focus is about to change. We will get to how and likely why that will occur in a moment, as I said. First, however, let's talk further about how the U.S. has been failing to adequately invest in itself. The recent banking problems of the Silicon Valley Bank, SVB, brought into focus for me the serious issues unfolding in America's rate of creation of viable small businesses. Having been in venture capital and private equity, I'm acutely aware of the pre-IPO funding process and the rigorousness that goes into each round of the funding cycle, a well-crafted process that assures sustainable competitiveness and viability of a future publicly traded company. Because of nearly 2 decades following the dot-com bubble implosion, excessive, fast, and easy money, this process has become unrecognizable and dangerously over-financialized. To make the problem easily identifiable, it is a matter of simply looking at the number of patents being filed in the U.S. If your competitive offering and intellectual property that the company is founded on doesn't merit a patent, what do you really have but a product that will be copied and sold at a cheaper price? The U.S. leadership in this area was previously seen to be insurmountable. That is no longer the case. The red areas on this visual capitalist chart not so long ago would have represented the U.S. Today, the red area is China. In second place is the U.S. shown by green areas, yet if you break it down by type, you'll see in many cases U.S. falls even more dramatically. What is being replaced with in the U.S. is a new form of misallocation of capital. We're funding cute ideas, readily adaptable to clever marketing slogans, and capture the imagination of quick riches by fast money artists and stock market manipulators. We have witnessed, apparently, sophisticated investment professionals who didn't have the intelligence to see the very evident risk of the SVB funding and capital model. Geniuses they're not, or at least no longer. In 2021, out of 1.6 million patents across multiple fields, 87% were granted to innovators from just the 6 countries highlighted here. After rapidly increasing its patent output in recent years, China topped the chart in 29 out of 36 total fields, including computer technology, electrical machinery, digital communications. The Chinese government's focus on innovation, not production, led to the nation's applicants receiving 38% of that 1.6 million patents granted in 2021. The United States, home to the world's largest tech companies, came in second with 286,000 granted patents by origin. The U.S. also topped 4 fields of its own: medical technology, engines and turbines, basic communication process, and unknown for inventions that can't be assigned to a specific field. Not far behind is Japan with 257,000 granted patents. It dominated the other nations in the fields of semiconductors and optics and furniture and games, cementing its well-earned reputation of technological innovation. The competitors have got much, much better, much, much faster. Unknown origin applicants for whom the nationality or country of residence couldn't be determined for the inventors accounted for approximately 25,000 of granted patents. When assessing which technological fields inventors are pursuing in 2021, it's not unexpected that digital and electrical technologies are in the lead. There are also many patents granted mainly in infrastructure-related fields, which have become all the more important following the COVID-19 pandemic and an increasing focus on trade. These include medical technology, transport, civil engineering, and semiconductors. The number of patents granted in 2021 is a testament to the growing importance of innovation around the world. While a select few nations have dominated the patent landscape so far, there are many others making significant contributions to innovations and technology property. This is further accelerating the change in these charts that I'm showing. As technology continues to advance and the global economy becomes more interconnected, the importance of intellectual property rights will only continue to grow in my mind. This is also about pretty packaging for suckers, frankly. Let's just talk about SPACs, or a special purpose acquisition company, which has become quite popular recently in the press. They're also known as blank check companies. It's a shell corporation listed on a stock exchange with the sole purpose of acquiring a private company, thus making it public without going through the traditional initial public offering process and the associated regulations thereof. I mentioned the process and how important it is. There's also the whole impediments associated with the massive amounts of regulations that went into becoming an IPO. SPACs have therefore become a preferred way for so-called experienced management teams and sponsors to take companies public. If a SPAC raises capital through an initial public offering, or IPO, for the purpose of acquiring an existing non-public startup, why wouldn't the target company just take itself public and reward the founders and investors who know the company and took the risk? Well, the answer is twofold. First, the money is made in the IPO investment banking fees and the peddling of the well-wrapped package, not in the time-consuming diligence of actually building something of sustainable substance. This is the epitome of buyer beware. Secondly, and the unvarnished simple truth, is that it is to avoid regulations that can land players in jail. As I mentioned about regulations, Sarbanes-Oxley regulations were put in place to specifically protect investors. SPACs would avoid these and other regulations, or make it almost impossible for the SEC, Securities and Exchange Commission, to effectively monitor and enforce. A knowing Congress has chosen to look the other way, as campaign donors' contributions from the high-tech field have become just too significant to be avoided. I think we need to look at the details behind the Silicon Bank and where that class has been a major donor to key leaders in the Congress, both within the House and the Senate. Unicorns are yet another slip of hand of the startup company process, where behind closed doors a handful of investors during the latest round of funding agree on a valuation of, let's say, $1 billion or more. Even though these deals are confidential, that $1 billion valuation is then dutifully leaked and hyped all over the financial media. There was a time when a newly created unicorn would unleash a torrent of oohs and ahs, but by 2021, there were so many of them, 340 of them, to be precisely, or about 1.3 per business day, that people stopped paying attention. So if you just don't believe me, as a single source, here's how Wolf Richter describes what is going on here, and I quote him. During the 14-year reign of easy money, which started in 2008 and ended in 2022, everything became possible, and there were no limits to asset prices and valuations, because when money is free, price doesn't matter. So the number of U.S.-based unicorns that were created in the venture capital world each year soared from 9 in 2012 to 344, or about 1.3 per business day, as I mentioned, in 2021. November 2021 was the moment of peak consensual hallucination, as I call it. Since then, the NASDAQ has dropped 27%. By mid-2022, the whole show started coming to an end. For the whole year 2022, only 185 unicorns were created, about 0.7 per business day. In 2023 through March 9th, only 5 unicorns were created, about 0.1 per business day. End of quote. The total number of U.S.-based unicorns that are still active climbed to 704 unicorns by March 2023, representing a mind-boggling aggregate valuation of $2.36 trillion with a T. These are unicorns where startup investors were still not able or willing to exit via some kind of sale, either by selling it to the public via an IPO or by selling it to a company with deep pockets. That's money out of circulation. During the easy money era, there was so much capital flowing into startups that they had so much funding they could stay private for longer, despite burning profuse amounts of cash, and they didn't have to seek a buyer or an IPO because they could always raise new cash to burn. This trend to more late-stage funding and staying private longer created more unicorns and bigger unicorns that were burning more cash, and then suddenly the music has stopped. That $2.36 trillion is a lot of money to be finding buyers for. In 2019, which has already been a big year, the aggregate evaluation of the 223 then still active U.S.-based unicorns was $652 billion, according to PitchBook data. Now the aggregate valuation waiting to go public or find a buyer is nearly 4 times as much. Late-stage funding into startups has come to a crawl. Many startups have approaching out-of-money dates. So there is pressure on these companies now to figure out how to burn less cash to extend their runway so that they can hopefully outweight this investor liquidity crunch. One way for startup investors to cash out is via IPOs, during which shares become publicly traded, and investors can then sell their shares during the IPO and over time to the public. With freshly minted IPO stocks and SPAC stocks crashing left and right starting in 2021 and continuing through 22 and 23, it became difficult for startups to engineer IPOs, and IPO volume collapsed in Q1 2022 and has remained low ever since, according to IPO data from Renaissance Capital. The other way for startup investors to cash out is to sell the unicorn to a big corporation with deep pockets that wants to get rid of the budding competitor or wants the technology or the consumer data or whatever, and they're willing to pay no matter what for it. But that's getting tough to do. Unicorns are likely to face significant challenges when sourcing potential acquirers due to a limited buyer interest, and the recent decline in M&A activity coincides with the current economic downturn. Only $39.6 billion in U.S. acquisition value has occurred since the beginning of 2022, which makes it the least active year since 2015. Data shows a mere 5 unicorn acquisitions in 2022, compared with 24 in 17 and 21 and 20, respectively. Additionally, many public corporations are opting to buy back company shares to appease shareholders and signal confidence in the company's future. So far, share buybacks have been favored over M&A, with buyback announcements hitting a record high of $1.2 trillion in 22. Additionally, the current antitrust crackdown on the tech sector has put increasing pressure on large tech companies such as Meta, which is currently being sued by the FTC for antitrust violations related to its acquisition of WhatsApp and Instagram. This crackdown is likely to continue, affecting cash-starved unicorns seeking acquisitions by large corporations. In this frozen cash exit environment, since 2022, exit values plunged by 87% from the record $768 billion in 21 to only $79 billion in 2022 and early this year. This liquidity crunch has limited the return potential for investors and is restricting the flow of capital back into the venture ecosystem. This dearth of capital is further exacerbated by the languid pace of fundraising observed through Q1 23, as well as an exodus of non-traditional investors that in recent years has played a major role in providing the large amounts of funding upon which unicorns are heavily reliant. The end of easy money ended many miracles, and after the ruckus party is now bringing them back to some sort of reality. This reality may be tough for a sector that has gotten hooked on an endless flow of money that made unicorns a paragon of this era. Companies underspent on Capex, or capital expenditures, over the past 10 years relative to history. Since the great financial crisis, for every dollar generated through operation or borrowed, 38 cents was spent on Capex versus 52 cents in pre-global financial crisis, 21 cents on dividends versus then previously 17 cents, and 24 cents on buybacks versus 13 cents. Second, companies shifted from spending on manufacturing and structures to spending on tech over the last 20 years. Finally, industrials spent most of the post-Great Financial Crisis period paying down debt, suggesting limited debt-driven PP&E investment. Fiscal stimulus, reshoring, and green goals are secular forces that could bolster Capex in spite of cyclical headwinds. While Capex may be insulated, the rising credit risks are more acute for buybacks and tech spending. The last decade of cheapening capital and falling hurdle rates incented companies to buy back shares. Historically, tech, industrials, and financials were net issuers of equity, but shifted to net buyers following the 2008 great financial crisis. So if corporations haven't invested in Capex for new products, U.S. patent leadership has dramatically fallen, and the SPAC, unicorn, IPO market is no longer the fertile M&A ground to buy a quick productivity solution. What are the CEOs likely going to do? If what we learned in the latest conference calls is any indications, CEOs are banking on artificial intelligence solutions to supply that silver bullet in a big way. 1 month ago, to much dismay and widespread denial, Goldman Sachs predicted that AI could lead to some 300 million layoffs among highly paid non-menial workers in the U.S. and Europe. Goldman estimated that roughly 2/3 of the current jobs are exposed to some degree of AI automation, and that generative AI could substitute up to 1/4 of current work. This is called a panacea for the CEOs if it's even partially true. Extrapolating their estimates globally suggests that generative AI could expose the equivalent of 30 million full-time jobs to automation, as up to 2/3 of the occupations could be partially automated by AI. IBM beat profit estimates in its most recent quarter due to expense management, including the earlier announced job cuts. In the past, IBM had managed to manipulate its stock higher thanks to billions in stock buybacks at much higher prices. But once its debt load grew too big, the buyback game had to end. Warren Buffett sold his shares and the stock price has languished over half a decade now. And since the company's revenue is stagnant at best, his only hope is to drastically cut overhead. Enter AI. New productivity and efficiency steps. Read replacing workers with algos are expected to drive $2 billion a year in savings by the end of 2024. That according to the chief financial officer, James Cavanaugh, which he said on the earnings conference call. Helping the company's imminent transition to an AI staff corporation will be the coming recession. Until late 2022, Krishna said he believed the U.S. could avoid a recession. Now he sees the potential for a shallow and short recession towards the end of this year, although it remains unclear just how one can determine that a recession will be shallow and short. The World Economic Forum has warned that the employment landscape will change drastically over the next 5 years amid increasingly widespread use of artificial intelligence. According to the World Economic Forum, in their report, the Future of Jobs Report 2023, roughly 23% of jobs, they think, are expected to change by 2027, with around 69 million new jobs created and 83 million eliminated, resulting in a decrease of 14 million jobs, or 2% of current employment. The report surveyed 803 companies collectively employing more than 11.3 million workers in 27 industry clusters and 45 economies from across the globe on macro and technological trends and their impact on jobs and skills, as well as the workforce transformation strategies that businesses plan to implement between now and 27. I encourage you to read the report. It's well documented and a lot of input from these 803 companies. It found that clerical or secretarial roles, including bank tellers, cashiers, ticket clerks, data entry clerks, postal service clerks, and administrative and executive secretaries, will likely see the fastest decline in roles over the next 5 years relative to their size today, with roughly 26 million fewer jobs by 27. Meanwhile, certain tech jobs, including those focused on AI and machine learning, sustainability specialists, business intelligence analysts, information security specialists, and fintech engineers are expected to see an increase in employment. Overall, the biggest job growth will likely be seen across the fields of education, 10%, leading to 3 million additional jobs, agricultural, 30%, or 3 million additional jobs, and digital commerce and trade, 4 million jobs, according to their report. Many are now beginning to name this the new bull market. What are the odds that this is going to be a new bull market? Led by a few that started in late 2022 will be named and known as the Great AI Bull. Tech leaders such as Zuckerberg, Pichai, Natella, Andy Jassy, mentioned AI a total of 168 times during their recent earnings calls. And who is leading the way in this new bull market? These people in these major corporations. AI and its older buddy, large language models, are driving 53% of performance in the S&P 500 year to date. So far in 23, we've had just 7 mega caps account for 90% of the gains in the S&P 500 year to date. Who wants to short this with AI coming on into these corporations? People could be driving these stocks up because of the productivity gains they see. I don't know. I have nothing to prove that. I think it's just frankly wild speculation and afraid to mend the old FOMO, afraid to missing out. But anyway, I digress. So, do you spell sustainable using artificial intelligence? Apple and Microsoft account for 39% of the S&P's gains so far in 23. Add in NVIDIA and Meta, and it's 60%. Productivity growth, making more with the same inputs, has been anemic for, as I've said, for over a decade. Since 2005, the quarterly labor productivity growth has been 0.3%, half of the average of 0.6% from 1947 to 2004. However, data shows that productivity is cyclical, and research ties into economic conditions. Historical evidence shows that tighter labor markets and technology adoption are closely linked. We're likely to see tight U.S. labor markets continuing for years, and is encouraged by resilient demand in the face of Fed tightening. The diffusion of new technologies, AI in particular, can fuel productivity growth. No question about it. Many see strong evidence that this data era thesis is intact and believe technology diffusion and can contribute to productivity gains over the next 5 to 10 years. When the next generation of AI was introduced as ChatGPT with a free beta download, the response was truly overwhelming. Almost immediately, it had over 500 million downloads. People I would never have thought would be aware of it, had already downloaded and were trying it for all sorts of creative and imaginative ideas and wanted to share it with me. It has been a while since I saw something catch people's imagination like ChatGPT did. Only a few months later, ChatGPT currently has 1.16 billion users, and it crossed 1 billion in March. Despite all sorts of issues in the initial beta version, and there were a lot, the potential is clearly there. ChatGPT and its follow-on versions and competitive offerings will revolve into a rapid overall AI technology soon to unfold. These will form a platform for application innovation that will rival what we saw apps do for tablets and phones a decade ago. I expect app developers will quickly explode with commercial offerings that will spread like wildfire across corporate service areas. I suspect the worker in an office cubicle or working from home will be prime casualties of this new wave of productivity tools. The question we must finish on is whether AI will realistically significantly disrupt the labor market. Will it begin the process of reinventing the middle class, white-collar worker, and what I referred to as the cubicle class? There are several historical examples of times that people wrongly predicted emerging technology will significantly disrupt labor markets, including the ATM, which I was part of with IBM, bringing it to market. When ATMs were first introduced in the 1970s, many people thought they would replace bank tellers. However, while ATMs did automate some banking function, they also made it possible for banks to offer more services and expand their hours of operation. As a result, the number of bank tellers' jobs actually increased. When the internet became widely available in the 1990s, some people predicted that it would lead to massive job loss. It didn't take long before this proved to be a completely false narrative. Yeah, jobs were lost, but vastly more were created. In the 19th century, the Industrial Revolution led to the mechanization of many jobs. While some workers did lose their jobs, the Industrial Revolution created many new jobs in manufacturing, transportation, and other industries. Wages at factories were higher than what individuals were making as farmers, and as factories became widespread, more managers and employees were required to operate them, increasing both the supply of jobs and wages. Today, a similar story is unfolding in the labor market. Take two real-world examples from the front lines of business and technology. ChatGPT and other generative AI technologies such as Jasper AI have swiftly changed the way content is created. For example, copywriters used to take several days to produce an article, which had to be edited before distribution. In total, the end-to-end process took about a week, which meant the company was producing 4 articles per month. Since beginning to leverage Jasper AI, the company now produces 3 to 4 articles per week. That translates into more leads, which translates into more customers, which turns into higher revenue growth and more hiring. Is our copywriter job safe? You bet. Using AI technology doesn't replace the need for her or her role. It supercharges it and helps the company scale faster, leading to more hiring, not less. Starship Technology is a high-profile technology company that has successfully completed over 4 million deliveries using autonomous fleets of robots. It's true that these robots have put humans out of work by replacing the need for people to physically deliver items. It's also true that this technology has created hundreds of new, specialized, higher-paying jobs for technicians, managers, operations, and logistics specialists that ensure these robots get from point A to point B as intended. Plus, it helps solve a very real problem for retailers that unlocks growth and margin, the last-mile delivery. While nobody has a crystal ball, AI has already been used to automate routine, repetitive tasks in fields such as manufacturing, data entry, and customer service. This has led to job losses in some industries, particularly in low-skill, low-wage jobs. As businesses continue to implement new AI technology, it's reasonable to expect more of the same. However, conversely, AI will continue to enhance productivity and drive efficiency, leading to economic growth, which results in the creation of new jobs. Looking back at history, every time there's been concerns over the displacement of jobs due to technological advancement, new jobs have ultimately been created. It's important to note that the impact of AI on the labor market will not be uniform across all industries and skills. Some industries and job categories will likely see significant job losses. Frankly, those working in a cubicle. However, it will be important for businesses and policymakers to prepare for these changes by investing in reskilling and upskilling programs to help workers transition to new industries and job categories. People will be glad to get out of those cubicles. So could AI steal your job? The answer is likely depends on your profession and industry, but just like previous technological inflection points, this disruption will create new opportunities as AI transforms work as we know it. What I see, productivity equals layoffs plus artificial intelligence. But we'll see both, but the net will be growth. What we'll also see is that we're moving to the suddenly part of slowly at first and then suddenly. It's an answer that to CEOs solves that seemingly unsolvable problem. But it's likely to be seen and adopted as a strategic imperative, a new competitive weapon, and a possibility of guaranteeing or offering a sustainable competitive advantage in the offering for the most innovative out there. As I always remind you in these videos, remember politicians and central banks will print the money to solve any and all problems, until such time as no one will take that money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful attention and not following what has traditionally been the true and right approaches. Things are changing. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2023 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.